Welcome to Kruse Asset Management's 2023 Market Outlook. I'm Stuart Kruse. I've got John Brick, Kruse Asset Management CIO, on today, and we're going to discuss where we think the markets are going in 2023. But first, I'd love to talk a little bit about our mission statement, and that, after about 20 years of being in this business, it's taken me a little time to distill this, but really what I think our mission statement is to be better, right? We want to be better than the traditional Wall Street firm. We want to be better than the S&P 500 with our QVP. We want to be better for you every single day, which is why we added that virtual family office last year and be able to provide larger breadth of services. We want to be better in the advice we give so it's conflict-free, unlike some of the large brokerage houses. And I think we personally try to be better every day as well. Isn't that right, John?
Absolutely. All parts of life. 1% better a day.
Yep. So 2022, as you know, was a pretty rough year. I think we navigated pretty well. We ended up doing, made this call a year ago today, or actually maybe it was the 6th, that the markets were overvalued and we were going to start reducing our equity position. And we successfully did that. In fact, we continued to reduce equity position in February. We sidestepped the largest down month in the last 15 years, which was April, by quite a bit. So we're pretty fortunate that that's what happened. And so let's talk about what's going to happen, or what we think is going to happen in 2023. So I'm going to share my screen. And we're going to look at the S&P 500. Right there. So here's a chart of the S&P 500. And here's the peak back there, January 6th. We peaked out, and over the last 12 months, we were down almost 20% in the S&P 500. And traditionally, you use a lot of diversification to help offset some of this risk. So when one asset class doesn't do so great, other asset classes pull their weight. But unfortunately, of all the major asset classes, there just really wasn't any place to hide. And if you were over allocated to technology, you did even worse. So instead of being down 20%, you were down 33%. Small cap wasn't a real benefit. You were down 21%. Being in international markets, you were down slightly less, 16.5%. But if you also allocated to emerging markets, down 23% there. So, okay, those are all equities. Now, if we shift gears to bonds, which are supposed to be your safe haven when the equity markets aren't doing so great, you end up with an aggregate bond performance of being down 14%. And in fact, top to bottom, bonds were down closer to 20% as well. It was the worst combined performance of a 60-40, 70-30 bond portfolio that we've seen in 20 years. High yield bonds didn't help any better. So that was down considerably, double digits. And the REIT market, which is publicly traded, was down 26%, again, close to 30. The only bright spot we see was in gold. So gold, which is supposed to be a flight to safety and a hedge against inflation, which is exactly the two market conditions that we were supposedly struggling against, gold did appreciate a little bit, but was down most of the year and finished flat. So even gold didn't help you. And heaven forbid we were in Bitcoin, which we were not, but that would have been down 75%, so lost 3/4 of its value in 12 months. And they were in a Bitcoin winter there. So how does this all shape up? Well, what we wanted to do is see what happens in 2023, and I'm going to compare this to what happened in the financial crisis. So I'm going to go to another chart. Here's the S&P 500 and the returns during the financial crisis from October of 2007 to October of 2008. And as you can see, we trended down throughout the year, that 12-month period, and we finished down about 25%. Now I'm going to put the last 12 months on, from January 5th to January 5th of this year, and that's this year's chart. 2022 to 2023, here's the financial crisis. Our current financial crisis. They look remarkably similar. So what happened during the financial crisis? Well, we lost 25% in the first 12 months, and the whole financial crisis played out over 6 quarters, and we ended up down 52% almost. So in the last part of it, we lost just as much as the first part and in half the time. So I'm not suggesting that that's going to happen to us this time, but it's a real possibility. And in fact, in general, when markets kind of trade down, we look for a flushing out. And as you can see at the end of this chart, there was a big drawdown at the end, which signaled the bottom. So we're going to keep an eye out for that flushing out in this particular market. So where do we go from here? And why do we think that? So I'm going to bring up a second chart, which is the 2-year Treasury. And this is how much interest rate you're going to get if you give the federal government your money for 2 years. And for the longest time, last several years, we were used to very, very low, modest interest rates in the low teens, call it, of returns. So like low teens of basis points. So not even 1%, not even 1/4%, but like 1/10%, and slightly more. So this is the interest rate environment that we're used to. And then inflation started rearing its head. And this is what the 2-year Treasury looks like now. Why is that important? Well, I'm going to put on top of that the 10-year Treasury. So that is now in orange. And again, you normally see the 10-year Treasury is above the 2-year. Because if you're going to give the federal government your money for longer, for 10 years, you expect to be paid more interest than you would for a shorter period of time. And that's in fact what we normally see. But here we see a crossover, and when that crossover occurs, that is called a yield curve inversion. That's when the 2-year is paying more interest than the 10-year. So we all like to look at that spread. What's the difference? Here the spread is positive, and here the spread is negative. Whenever you see that spread is negative, it's an inverted yield curve. So if I put up the 10 and 2-year spread on our chart, that's this light blue line. So whenever this blue line turns negative, the yield curve is inverted. So I'm going to clean this up a little bit and just show you the spread. So you can look at this. Here's the 0 line, and here's where the spread goes negative. And that means the yield curve is inverted. So why do we care? Well, let's see why we care. Let's look at the long-term chart of this 2-year, 10-year spread. And we're going to add the U.S. recessions. And let's see if we can notice anything about this pattern. So here's the 0 line. Anytime this line goes under that 0 line, the yield curve is inverted. So here we have an inversion, then we have a recession. Here we have an inversion, recession. No inversion, no recession, up, inverted, recession. No inversion, till here, recession just a few months later, inversion, recession. Small inversion, small recession. And this is where we're at right now. So, as human beings, we follow patterns, and this is a pretty good pattern. Every time we have an inverted yield curve, we've had a recession afterwards. Now, in fact, every time we have a recession, one of 3 things happens. Either you have an inverted yield curve, you have higher energy costs, or the Federal Reserve is tightening. And we have all 3 right now. So that almost, I won't say guarantees, but it gives you very high probability of a recession coming in the latter part of 2023. So to talk about another aspect of this yield curve and why this is important. So we're in an inflationary environment, and the reason the Fed is tightening right now is to combat inflation. So if we look at the 2-year note again, and I'm going to take this down to a 3-year chart, not max chart, and I'm going to show you the federal funds rate, which is the only interest rate that the federal fund manipulates. So they get to change this. The 2-year and the 10-year are driven by the market factors and forces. But here we have the federal funds rate that is dictated by the Federal Reserve. And so as you can see, the 2-year has traded above the 10-year for quite some time. And anytime that happens, when the 2-year is slightly above the 10-year, that is somewhat of an inflationary force. And in fact, the Federal Reserve has never been able to successfully combat inflation with the Fed funds rate below the 2-year. So as this 2-year started rising, that's when the Federal Reserve started suggesting we needed to start adding. Now, they paused for a little bit. They didn't start adding because the economy was really still on shaky ground, so we thought. But the wider this spread gets, the more inflationary pressure this 2-year is causing with the economy. So then the Fed started raising rates aggressively. They raised it 425 basis points in the last year. And some economists are saying, why are you raising it so fast? You're going to crush the economy. Well, the idea is Powell wants to not crush the economy, but he desperately wants to fight inflation. He's a student of Paul Volcker, who fought inflation in the 70s and 80s. And only when he raised the Federal Reserve rate, the funds rate, above the 2-year, was he able to fight inflation. And we are still below that number right now. Right now, the Fed funds rate is at 4.36, and we're at 4.25. So we're still slightly under it. So he still needs to raise rates. And in fact, Powell said we need to raise rates and keep them there for a period of time. So why would he say that? Well, he says that because there's an economic theory, and in fact, you see this play out a lot of times in the financial markets. When there creates all this spread, which can be visually represented by the area between these two, between the orange and the purple line, that's all inflationary pressure, and he is trying to create deflationary pressure. So he needs a substantially sized area on the other side of that. So that orange line needs to go up above the purple line for roughly the same period of time to create roughly the same amount of area out here. So that's why he's saying I'm going to raise the rates and then keep them higher for longer. So that's what he's looking to do, in my opinion. And that will add to the recessionary pressures that we're going to see in the market and cause the economy to drop down. So that's why we might see a big drawdown in the market in that first half of 2023, like you saw in the financial crisis, where you had just an acceleration of the decline of the S&P 500. So that's one reason, or a couple of reasons, why we think the decline is going to go. John's going to talk about some other reasons for some more fundamental reasons about why we may see a decline in the stock market in the second half.
Thanks, Stuart. Share my screen here. Here we go. Okay, so as we look to the performance of the S&P, we can break it down into two different parts. First, you have the valuation, forward PE ratio, and you have the earnings of the S&P. Simply stated, if you multiply the earnings per share expected of the S&P times the valuation multiple, you get where the S&P is going to trade. So what happened last year, this graph that you can all see here, was, I guess going back one step, during COVID, when the Fed pumped a lot of money and Congress pumped a lot of money into the system, we saw the valuation multiple of the market expand dramatically, somewhere from around 17 times to over 22. 2022 gave almost all of that back. So if you look at the S&P last year in 2022, down around 20%, 22 to 23% reduction in the valuation multiple, and a few percent for the earnings growth. So now where do we stand? Well, and where are we going to go? Let me see here. So here's the earnings estimates. So as you can see, a little going back a couple steps, 2021 had a lot of pull forward demand from the low COVID era, and we had somewhere around $212, $210 in earnings. 2020 is still outstanding because the fourth quarter earnings are being reported now in January. But as you can see, it's somewhere between $200 in earnings, and 2023 expected to be $222 in earnings. So given the lesson, the math lesson, I don't know if you can see this calculator or not. However, a 17 times multiple, which, going back 2 slides, is the average, and where we're at now, times $225 in earnings, gets us $38.25 on the S&P. This is the SPY ETF. This is the S&P index. We're at 38.08 right now. All things considered, we could have a flat year if the valuation multiple stays constant and earnings do not fall back down towards 200. We're a flat market. But what Stuart showed you is the earnings, the Fed funds, the yield curve inversion, and the recessions sort of give us hints that we're going to be in a recession. And so let's talk about a scenario analysis. Well, if we avoid a recession, which is possible, they call it the soft landing, we're in a flat market. Maybe we have a little bit of a drift up somewhere between 3-5% on the S&P total return. If we do not avoid a recession and the soft landing does not happen, we call that a hard landing happening. We get a recessionary environment, earnings get cut, and maybe we get a valuation compression. Now see, we're at a valuation of 17 times, which is the historical average, but oftentimes, as you can see here in the 08 and during COVID, the valuation falls and we get compression. So we can do a quick little math here, and we say $200 in earnings times 15 times on the S&P, we get a 3,000 multiple, or 3,000 S&P. Now, here's the chart of the S&P. Here is where we topped out in January, and we had our webinar on January 6th. I think Stuart mentioned that, and we caught risk in January and also again in February. So we pretty much reduced equity exposure through this whole thing. We were prepared for this outcome. And we are again prepared for the likelihood that we fall somewhere down here in the S&P, giving a couple factors. First, fundamental reasons that Stuart talked about, high oil, Fed tightening, the probability that the Fed tightens even further and stays there, puts the likelihood that we fall into a recession and we fall down here a lot higher than the likelihood that we somehow get higher than expected earnings growth, valuation expansion, and a breaking of this downward trend. So that's the fundamentals. And just backing up one other step here, we have these higher lows in the S&P. High, 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 high.
Lower highs.
Lower highs, excuse me. Lower highs. And so we pretty much have this nice looking channel, and this kind of fell down here. So all things considered, we kind of have a visual reason. We're below the 200-day. We have the math suggesting down here. All things considered, we're kind of expecting a lower market. I think we should pause there and maybe pivot to, this sounds bad, but we have a lot of opportunities. And I can talk to one here. Actually, I can maybe talk to two of them. But opportunities. Throughout this whole year, a lot of the money in accounts that we sold, the different equity exposure, the different bond exposure, we put in the treasuries. And the graph that Stuart showed the 2-year treasury up at 4%. So while the market was falling down 20, bonds falling as well, we put money into treasuries yielding 4%. So we made money in the down market, and we still have that same position. We've actually increased some of that as a likelihood that we have a flat to down market increases, we put more money in treasuries. The opportunity set number 2, which is actually kind of exciting, where I'll use my own words, maybe excited for a down market. We're losing money on a relative basis, or on an absolute basis, but relative to the benchmarks and how portfolios are positioned, we kind of want a down market. And let me tell you why. Most of the money is protected, or some of the money is protected in treasuries yielding 4%. But once we break down through these lows, and Stuart said it well in another meeting, where we have a capitulation event where it's kind of a washing out of the market, we are going to step into that and buy assets low and hopefully get us to the other side where we get through these downward recessions here, and we have a nice multi-year uptrend of over 100%. And maybe we'll get lucky and find one here where we ride out the market up 400%. So let me explain some of those structured notes, which is basically the thing that we're excited about. So the structured notes are in agreement with another bank. It's like a CD where we track the index, most likely the S&P, where we have upside leverage and downside protection. And so some notes that we've been pricing out, we looked at one recently at the 10-year note, not reasonable for everyone's portfolio and risk tolerance. But we can look at between 3, 5, 7, and 10-year notes that have upside leverage. The 10-year note, let's just go to the most favorite one, has an upside of somewhere around 180% upside leverage and downside leverage. If you come down, or downside protection. If you come down to the 7-year or 5-year note, maybe that number is 150, 120, 130, somewhere in there. Either way, we're prepared for the market to drop to new lows. We're going to step in if all goes well and buy all, upside levered assets and hopefully ride out the market higher over the next couple of years. And so I'm excited about that because if done well, I think it would be a great way to ride the market with upside leverage and not buying other assets, other good stocks. And I think, Stuart, maybe you can talk to some of the other stocks and sectors and everything that we've been looking at to try to find opportunity.
Yeah, absolutely. I'm going to grab the screen away from you for a second. And I did want to touch on one more thing, which was this one more reason why we think the market's going to fall. Here is a chart from our friends at JP Morgan. This outlines bear markets, the last bear market since 1929. And here's what, 15, 20 of these bear markets that they outlined. And at the bottom, you see average downtrend is 41% top to bottom. This is a bear market return. So we're down 20%. And the average duration is 20 months, and we're 12 months in. So to suggest that we have another 3 to 6 months doesn't even really get us to an average bear market. And to suggest we're down another 20%, again, doesn't even get us to the average bear market. So to suggest that we might be down 20, 25%, that just takes us to a very normal place in what the economy has done over and over and over again throughout history. So it's almost a bad sign that all the things are aligning and pointing to the very same thing. And sometimes when that happens, then that never occurs. But still, it's much less likely that we're going to miss a big opportunity to the upside than we're going to not have this downside. So we're definitely protecting on the odds where we're going to see a downside, and then we'll be able to step in later, as John said. So what he also indicated was, in addition to some structured notes, and just what we did in the last year, here's a chart of the S&P 500. And this is a 10-year chart. So each one of these bars, or what's called the candlesticks, are a month. And so this is a downward trend of the S&P. This is the year that we just went through. This was post-COVID. So if you can see, the S&P went up for like 8 years on a particular trajectory, and then it fell down, and then it went up at a different trajectory post-COVID. So I drew this line out here, and we're basically at fair value. And the same principle holds that this area above the line often has to be made up on this other side. So if we get this downturn before we can get that upside. But we watch the S&P drop, but our models have us look at the entire investable universe. So it's not just the stock market, which is oftentimes 80 to 90% of what we see in other professional portfolios. Well, they will just come with domestic stocks and bonds, and often concentrated in technology. That's not what we do. We look at, through math and statistics, we look at everything. So when we're looking at and scouring the universe, the investable universe, we come across different sectors. And in fact, one of the main sectors is XLE. And unfortunately, I'm typing over myself there. So one of the main sectors is XLE. And in those momentum models that we see, XLE bottoms out here and starts to show buy signals. So we started to get into XLE back here. And in fact, most of our clients profited from being in XLE during this last year. So that was the energy sector. The energy's been doing great. Same thing for commodities. Commodities also doing great. And so we were in commodities prior to there being an inflation scare, right? So that's just one thing. The other thing that we wanted to talk about was, again, diversifying away from just large cap domestic stocks, and especially just large cap technology stocks, because usually when a sector leads an economy down, and into a bear market, it almost never leads it out of the bear market. There's some other sector that has to lead it out. So that's why maybe we look at energy or finance or utilities or consumer staples or whatnot. But alternatively, if we look at the domestic versus international markets, here's a chart that talks about how long a market has been in favor. So the purple is how long has the international market been in favor and outperformed, and then the grayish bars are how long has the United States market outperformed. And so international, United States, international, United States, back and forth, back and forth. As you can see, each one of these ends in a very sharp peak, and then the next peak is when you have outperformance, right? So here we've had the longest stretch of outperformance that we've seen so far. And in fact, here's the peak, and this is tailed off. So this tail off actually indicates a potential outperformance. And in fact, during this period, the international markets have outperformed the United States markets during this period. So in a year from now, maybe this chart looks like the line's drawn here and we start a purple chart right here. But why would we do that? Well, if we look at this is the international price to earnings discount versus the United States. So basically, what's the PE ratio of the international stocks versus PE ratio to United States stocks? And up here, down here, it says basically international stocks are as cheap as they've ever been relative to United States stocks. And so whenever you're 2 standard deviations out, that's, what's the number? 97.5% of the time, the markets have not been this cheap or this disconnected. So almost always when you see a 2 standard deviation move, it's not very much longer that you get a regression back. So what that would indicate is the international markets should really start to outperform. And in fact, it looks like they have started to outperform a little bit. So where does that leave us? Well, when we're looking through different countries and different investment universes, it looks like Turkey was on a downward trend for a long time and it's starting to break out. So we put Turkey in our client's portfolio, and Thailand is in our client's portfolio because of some of this breakout here. And so we're going to keep scouring our 45 different country ETFs to look for countries that are potentially going to be breaking out and be part of an upward rising, even more so than the United States, right? Other things that we look at, gold we talked about that had a rough year, so it was in a decline for a while, and now it looks like it's starting to break out. Finally, it's supposed to be a inflation hedge and a flight to safety, but even silver, which hadn't done so well, now is also looking to break out, and I think palladium was another one, right?
Yeah, PPLT.
PTLD?
PPLT. PP.
One more time.
PPL, Larry Tom.
Is that it?
Tom.
There we go. There we go. There's palladium. Thank you. So there's palladium that's breaking out. And other bear weather friends like copper. Copper's still on the decline, and copper tends to be an indication of business booming, and it's not. So we're looking at all these different factors that are indicators of where the economy's heading, where can we put your money that is poised to move up, as opposed to being part of the headline risk that you see on CNBC or Wall Street Journal or what have you.
GE, even stock specifics too. GE, IPGP. And so,
GE is bringing out.
Look at that.
IBB.
Yeah.
And biotech is looking to bring it up. So this is what we do on a daily basis. We look for sectors, segments, countries, not just United States stocks, as a place to find Solstice, as kind of like one of the famous personalities says, there's a bull market somewhere, and we're here to find it for you. So we use math and data to find it for you. With that said, John, we're going to talk about some alternatives.
Sure. So, we do only have a few minutes left on our recording, so I'll get right to it. Last year was a horrible year, as we showed in the graphs and discussed all the asset classes, bonds, stocks, a horrible year for even a diversified portfolio. And a lot of the portfolios we've seen from other advisors and other firms, just down a ton. Not good. So one of the ways that we can diversify away from that and try to protect against that, and even help create alpha, is through alternatives. And we've been really trying to implement more of that in 2022, and we're going to try to push for more of that in 2023. So to give you a couple examples of what we've been looking at, without giving away any names, we have a private real estate fund, 2 private real estate funds, and a private equity fund. Both private equity, private real estate are positives this year. So the S&P down 19 or 20%. These funds were up, give or take 9, based off the end of the year mark, up or down. And the other one, I think, was 6 or 7%. Either way, a positive return in a down environment.
It's a big win.
Big win. And if you look at the private equity fund, we talked to the managers, we talked to the companies, and we identified one that we think is less Wall Streety than others, that actually owns underlying businesses, and you profit based off the company's cash flows, not based off of valuation changes and Wall Street gimmicks. That one was up, like I said, give or take the end of the year mark, up about 7%, an absolute winner in a down year. And so as we look out over 2023, we're always scouring, and I had another call today with another manager. We're scouring a bunch of different asset classes, like Stuart showed, in the public market, but we're also doing the same in the private market. And based off risk tolerances, account balances, and et cetera, we would love to discuss further with you where we can place some of your assets and some more attractive alternatives this year.
Sounds good. All right, so to sum everything up, we made a call in 2022, early 2022, that helped us reduce risk for our clients' portfolio. It turned out to be the right call. Again, using math and stats, it's not always the right call, but if you make enough of these with the odds in your favor, you eventually come out on top, and that's the philosophy that we have. And we really built out our virtual family office so that you have not just investment advice, we can have advice for buy-sell agreements, premium financing, cost segregation, advanced estate planning, tax mitigation. I mean, we really aim to be better and be your personal family CFO. Like, that's our role for you. So really, in an ideal world, we want you to say, I've got a financial issue. Let's talk to Stuart and John and see if we can get it solved. And 99% of the time, somebody in our network and on our platform can help you with that problem. So we'd be your one-stop shop. We help you solve the problem or take advantage of an opportunity, and we go from there. So that's how we want to be better. We continue to expand that in 2023. So that theme of 2022 continues into this year. We think it might even be a little bit more compressed, where we'll see a downturn, maybe even a pickup, and then hopefully, as the market looks through the recession in 2023, we'll see a bottoming out and then a march upward. Now, I don't know that the market will finish positive, but we hope that there will be a directional change at some point that we can step into, buy these leveraged products, end up buying other investments in stocks and bonds that are in favor. Probably won't be heavy on technology because their multiples will still be pretty high, but that's what we aim to do. Any other final words, John?
I think, we're always watching. We're always, rejiggering our thesis. Data changes every day. We're watching every day, and our mentality here worked last year. The data shows, and we're prepared for what we see now, favorably. And if that changes, we'll change. But I think we're pretty, well prepared for this market.
Yep. So, we let our data be the guide, let statistics be the guide, and we'll continue to work hard for you to be better in 2023. And for clients of ours, please sign up for your end-of-year client meeting that is we have a schedule between January 17th and January 27th. I've sent out a couple links, but happy to send another one to you. You'll get more. And That's all we have. So that's our market outlook. We're going to have these quarterly because I think this is going to be kind of a changing year quite a bit. So we'll have another one in April 5th and July 5th or maybe the 6th. We'll see. But we'll send out notices, so we'll have them quarterly. And we'll keep you up to date. We'll keep in constant communication. And we're off to a great start in 2023. We're looking forward to an awesome year. So this is Stuart Kruse and John Brick signing out on our market outlook.